I'm Frank Angelos. I'm the managing partner here at CNA Financial Group. It's my pleasure to be with you this Wisdom Wednesday. We have a special program with you today. Our guest this evening is Don Graves. So, Don, it's a pleasure for you to be with us. Don's background is he is an expert teacher, author in the area of what we refer to as housing wealth. And so, what came about recently was I happened to be in a seminar. I think it was down in, Texas.
Dallas?
And when I was down there, I'm sitting there and, like any other seminar, I'm listening to the different speakers until I saw Don. And then when I saw Don, it hit me and I said, oh, this is a piece of the puzzle for retirement that is often not viewed, not spoken about. And what I mean by that for all of our listeners is in what we do, it's common for us to sit there and I do, a balance sheet and I go through somebody's assets and liabilities and where they stand. And then we talk about retirement. And then when we talk about retirement, we'll look at the retirement accounts and the savings accounts. We'll look at all that. And there's this bucket of money.
Mm-hmm.
And then we speak of how that money gets dispersed over a period of time, how Social Security works. And, over the years, Don, you've written 3 books on this and, I've written books. And I always used to say that a house was, an asset, but it's a deferred asset. And I used to call the house a deferred asset that the kids would get. They'd spend it down the road or whatever the case might be. But I would review the house or view the house as a cash flow liability. And I go to this meeting down in Dallas and I hear you speaking and it was like you hit me in the side of the head. And I found that to be not necessarily as true. And you have spoken on this for over 20 some odd years.
Yes, sir.
And I just had you do a program with our advisors, spending a couple of hours just on teaching us the ins and outs of this. And so, Don, I really feel honored that you're here with me today and we're having this conversation for our, CNA community. So, Don, welcome.
Frank, I'm the one that's honored. And my throat, oh my gosh, we talked so much earlier. It was it was fantastic. Thank you for being so forward thinking about retirees' financial future, holistically minded, protection first, but not fearful. And I appreciate that.
And it's interesting when we speak on housing wealth, which, Don's going to give us a great insight on. Again, it was like a light bulb went off and it was like, all of a sudden it was like, if you think of like a 3-legged stool, we would look at, retirement accounts, and that bucket of cash is one. We look at Social Security and pensions as another. But the house, we never saw that way. And yet your, last 20 some odd years of your career, you've been actually sharing with people how to actually turn what I would call that deferred asset into lifestyle today. And how to enjoy housing well. So with that being said, Don, maybe, share with us how you kind of got started on that journey a little bit, because I know you teach at the American College. Again, you've written on this, you speak on this, and you are the resident expert.
Retirement's going to last longer than most people expect it to be more expensive and less predictable. How do we navigate such a long retirement? Well, most people have 3 traditional buckets that they draw from. The income bucket, Social Security, pension, if you're lucky, employment. Your investment bucket, IRAs, 401ks, a business you may sell, a house in the Hamptons. And then your insurance bucket, fixed and variable annuities and whole life insurance. So Frank, here's the question. Will those 3 buckets be enough to sustain you for the entirety of your retirement and maintain their purchasing power? And I asked that to clients, and I think honest people say, I'm not sure. And I said, neither am I. The good news is that 87% of retirees have a 4th bucket. It's called housing wealth. And it's not something new. And we used our housing wealth when we bought our first house because we didn't have 200,000 or 300,000. So we were saving for retirement as a young couple a lot of times. And then we used it again for home equity loans or home equity lines of credit. But now that we've reached retirement age, what's an age appropriate equity release strategy that allows us to leverage the home, to use it to strengthen and lengthen those other buckets? Well, what I found 25 years ago was someone introduced me, not someone, my sister, Michelle, introduced me to this idea of a reverse mortgage. Now, wait, Don't turn off the podcast. I know you just got a quivering when you said that. And Frank, I said, you know what happens? You mentioned reverse mortgages at the barbecue. You know what happened? Three people dove under the table, three people left the table, and your Aunt Janie made a shank out of a plastic knife and fork and came after you. That sometimes it's just dangerous to mention a reverse mortgage. But if we slow down and we'll back up a minute, I'm going to share a few things today, and I want to take the spooky out of it. What is a reverse mortgage, folks? IJAM. It's just a mortgage. It's part of a three-legged stool of a government-sponsored retirement. The first, 1935 Social Security. Well, no, that's not spooky. The next is 1965 Medicare, and the third is the home equity conversion mortgage, HECM, and that's sponsored by the federal government in 1988. What is it? It's a federally insured loan for retirees that allows them to convert a portion of their home's value and turn it into tax-free dollars without giving up ownership coming off title or requiring them to make any monthly mortgage payments. And so it's really just a home equity loan or line of credit for retirees, but there's some age requirements put on that. And so when we say, now wait a minute, 87% of retirees have a home, and we've got a retirement that's far from certain. What could it mean if we begin to look at our home equity in the form of a reverse mortgage? What could that mean for our retirement satisfaction? And that's what you called on to, and that's what we're here to kind of share a little bit about today.
Sounds great. So having said that, I know we've got some, you know, examples and some insights that we're going to share. So we're going to share our screen with everybody. So just give me 1 second. And those of you who've been with me for years that I've been doing this, you know I'm technologically challenged. So I always appreciate your patience as I set up something like this. So Don, I think everything is working.
Let's see. There we go. So on your screen, this is a mini masterclass using your home to dramatically improve retirement outcomes without losing home ownership or giving away your children's inheritance. Because Frank, that's what people think about when they think about a reverse mortgage. I'm going to give away my children's inheritance. So I said earlier, retirement is different. Climbing up the mountain, getting to the top was what we focused on, but coming down the mountain or retirement income planning is where we're at today. The challenges of that, the risks of it are real. I mentioned earlier, retirement's going to last longer, be more expensive and less predictable. And so the resources we have, your income bucket, insurance, investment buckets, and then your housing wealth. So that's what we're talking about, folks. We're looking at the fourth bucket, housing wealth, and that's the elephant in the room. Oh, reverse mortgages are scary. Reverse mortgages are that. And I think, Frank, what you discovered and what many have discovered is they may not be um, as terrible as we thought when we begin to unpack what they're really designed to do. So I want to give just a few quick questions. Sometimes for those who are watching or listening, I say take out a pen or paper. I said I'm going to ask you 10 quick questions. They'll be fast, less than 60 seconds, and I simply want you to answer yes or no to these 10 questions, or if it's not applicable, but not applicable. If your home could be used to increase your cash flow in retirement, would you want to see how it works? Yes or no? If we could use your home to create a backup plan for market risk and volatility, would you want to see how it works? If your home could be turned into a reserve fund, this is my favorite, that was growing tax-free at 6 to 8% and could potentially surpass $1 million, would you be open to seeing more? If eliminating a monthly loan payment meant your retirement savings could last significantly longer, would you want to see how it works? If you could turn your mandatory monthly mortgage payment into a voluntary one, would you want to see how it works? And I'll just put these five up there because it says the same thing. If we could use your home to minimize income taxes you pay in retirement, leave a larger inheritance, defer Social Security, replace income, or create a long-term care health plan, if you could use your home to do any of those things, would you want to see how it works? Well, folks, that's what the newly restructured reverse mortgage is designed to do, to help you to accomplish not just those 10 things, but a lot more. So certainly in today's podcast, we can't cover all of that. And so if you want to see reversemortgagemasterclass.com, that's where I teach 50 minutes and I cover it all. So we're just going to be sharing a few minutes, but bookmark that, reversemortgagemasterclass.com, and you can get it. So Frank, we just came out of your larger meeting and we covered these in detail, But here will just be an overview. What is a reverse mortgage? Well, I said it's just a mortgage. It's just a mortgage. It's a federally insured non-recourse loan for those age 62 or better. Allows them to convert some money without having to make payments or coming off of title. It's one leg of a three-legged government stool that I mentioned earlier. And how are initial benefits determined? Now, this is important for those who are watching or listening. Three things determine the amount of money you get from a reverse mortgage. Age of the youngest borrower, someone has to be 62. Home value and interest rates. That's going to yield a benefit amount. So whatever loans you have against the property, outstanding loan balances, we're going to pay those off. And then what's left over is called the growing line of credit. What are your responsibilities when you get a reverse mortgage? Live in the property. If you're married, at least one person has to live there. Take care of it. Pay your property related taxes and keep insurance in force. And the loan gets repaid when the last surviving borrower permanently departs the house. Whatever money you borrow plus what has accrued gets repaid. 100% of the remaining equity passes on to your heirs or your estate, and you have 6 months to repay it. So let me give you four nevers, and Frank will turn this off and we'll come back to you and I. But four nevers. You never give up ownership or come off title. You never owe more than the home's value. You never have to leave the home if you spent all the money. You never have to make loan repayments in advance of leaving the home. It's just a mortgage. Let me pause there, Frank, because I want the folks to see you and I. Let's we'll stop share and then we'll come back to that in a minute. So I'm curious. You heard me a month or so ago, and you, like many people, including myself, when my sister called me in 1999 and she said, "Little brother, I want you to look at this reverse mortgage." I said, "A who? A what?" And I was CEO of Habitat for Humanity in Philadelphia when she called me. And I thought, and my sister's 14 years older than me. And Frank, I said, that's it. She's finally done it. After all these years, she's finally got involved in something that's going to send her to prison. She's taking old people's houses, and I don't want anything to do. And I don't know, I don't want anything to do with that. And I dismissed it. I dismissed it out of hand. It was about a year later. I said, let me look at it. And there were 5 counseling agencies in Greater Philadelphia that did reverse mortgage counseling, which is a requirement if a consumer wants to get it. I called all 5, got breakfast with 3, and I sat down, Frank, and I said, "What's the aha, the fine print, the gotcha?" Because I wanted to know. A good name is worth more than great riches, the Book of Life says. So I didn't want my name associated with some nonsense. And I sat with these HUD counselors. And then I went to HUD itself, the United States Department of Housing, which is at the Wanamaker Building in Center City, Philadelphia. I sat with them. What's the aha that got you the fine print? And folks, after I did all this research, I came away in 1999, beginning of 2000, saying, wow, this could be a very important tool if used in an appropriate way that could make a huge difference for retirees. And that was my entree into it. So when people say reverse mortgages, ooh, yucky, gross, I get it because that's exactly what I said. But Frank, I'm curious for your listeners. So you come into the theater. It doesn't say reverse mortgages, just say housing wealth. And all of a sudden, here's a person talking about reverse mortgages. What was it, or what did you hear, and when did you hear that all of a sudden something said, huh?
So what was interesting, Don, is when, you know, I was familiar with reverse mortgages a little bit, years ago. But if we were playing chess, I would have viewed a reverse mortgage as one of the last pieces on the chessboard. But then when I sat in on your meeting and I was watching this, what I saw is that it didn't have to be the last piece on the chessboard. It actually becomes an orchestrated strategy
Mhm.
in the overall planning.
Mhm.
And so, the example, that you had given was, showing one example that we showed it with a wealthy couple down in South Jersey. And it was showing where they paid off, a couple $1 million mortgage, saving themselves, say 15,000, or I think the number was like 20,000 a month.
21,000, yeah.
And then it showed how they did their estate strategy in there, and they used part of what they were saving per month in their monthly premium to fund insurance. And then it showed that an extra $6,000 a month of cash flow.
Mhm.
And I sat back and I said, wow, that looks like some of our clients,
Mhm.
but it wasn't a client that was running out of money and the house was the last piece on the table. It
Mhm.
was an orchestrated strategy that fit into the overall planning.
Yeah.
And when I saw that, and then as you went through different examples, I just looked and I said, this needs to be a part of the conversation, that people need to know that it's a viable option, it's a viable strategy, and it's not what the old school was
Mhm.
of what we used to kind of envision,
Right.
which is like, okay, well, it's the last thing you got to play. You're out of money and
Mhm.
let's go to the house last. And, that's when it clicked for me. And then, we just spent, a couple hours with you in front of our, advisors. And as we went through more and more strategies, I was like, our clients just need to know that this is one of the, went from a three-legged stool to the four-legged stool,
Yeah.
that it is
Yeah.
a part of, wealth, and it's a part of the process. So that was when it clicked for me. And then I was like, every one of our clients, it's like anything else. It's not that it fits for everybody, but it's an option that people need to know is available, and they need to know how it works and how it actually fits in if and when.
Yeah. Thank you. I said it earlier at the beginning, for being forward thinking, for allowing your team to understand it's not always an appropriate fit, but I do think it's always an appropriate conversation to have, particularly if someone has a home. It's just good to know. Let me share some of the strategies that we talked about today. We're going to go back and share our screen and see if we can pick up where we left off. Let's see. Okay, let's try.
Remember, I told everybody I'm technologically challenged.
All right. So it's just a mortgage. It's not a last resort. So you remember this triangle: age, value of the home, outstanding, gives us this line of credit. And here's a powerful feature. This line of credit, you'll notice across the top here, 4, 6, 8 $1 million home value. You see that. And so let's say at age 65, someone gets a reverse mortgage and they're in a $600,000 home or $800,000 home. So the initial benefit amount on an $800,000 home is $267,000. But notice, it's a growing line of credit. Frank, let's go back. I can't, somehow not click on that.
Hold on one second. Do you want to go back?
No, I can't advance it. Just click on the PowerPoint, just anywhere in there, I think. There we go. Thank you. So notice the reverse mortgage started at 65, but it's grown to $1 million and close to $2 million. And I had a lady said to me one time, Frank says, Don, I can always access my home equity. And I said, no, you can't. So no, I can always go get a home equity line of credit. I said, do you realize when COVID hit that 5 of the nation's top banks, the top 5, stopped their home equity line of credit? Wells Fargo, Chase, Citi, um, Bank of America, and I forget the fifth one. Well, 2 of them came back in a year, 2 of them came back in 2 years. And as of a few months ago, Wells Fargo hadn't come back with a traditional home equity line of credit. So I said to her, you cannot always access your home's equity. So here's the questions I had to a retiree. I said, if you had a choice, would you rather your home's equity be liquid or locked? Well, she said liquid. I said, would you rather be growing or stagnant? She said growing. What about cancelable or non-cancelable? That happened in 2008 when people discovered that their home equity lines of credit could be reduced, frozen, capped, or even canceled.
I remember that.
And that surprised some folks. I said, if you took money out, would you like the payment to be mandatory next month or voluntary, government insured or non insured? And she said, all of those in bold. I said, well, that's not a HELOC, that's a RELOC. That's a reverse mortgage line of credit, which is, or a retiree's line of credit, which is uniquely geared towards you. So I said, it's not a last resort. It's something that you may want to consider setting up now. So let me give you the third and final. I'll give you just real quick, those who are watching. It's more than a television commercial. We've all seen television commercials. I'll give you a few. Optimizing Social Security conversations. I wrote an article. You can call Frank and he'll get this to you if you. But 7 ways to improve Social Security plan with a reverse mortgage, and it simply looked at that line of credit and talked about what if my cost of living adjustment wasn't enough? What if the Social Security I get is not enough and I don't want to draw from my other investments? How do I place income from a spouse? How do I stop my Social Security from being taxed? I said, mitigating risk with a housing wealth reserve. Well, that's that line of credit we just talked about. All the things, there are 18 major risks in retirement. Um, Tax rate risk, public policy risk, long-term care risk. Many of these, if not most, can be mitigated or even eliminated by understanding and setting up this reverse mortgage line of credit. Now, here's the low-hanging fruit that I want to pause on is managing mortgage payments. Here's a question. If eliminating a loan payment meant your retirement savings could last significantly longer, would you want to see how it works? Absolutely. So Steve and Barbara here, they've got 500,000 in an IRA, and they want to take out $30,000 a year. They've got a $200,000 mortgage and they have a monthly payment. By the way, 6 to 8% of people coming into retirement have some sort of house payment, and they're concerned. So the reverse mortgage made 224,000 available. The first thing it did was paid off what they owed and left them with a small line of credit. So for those viewing, I want you to think about this. Think about, Don, I've got a loan payment. So look at these folks. What did the reverse mortgage do for them? Well, first it eliminated a $1,500 a month payment. But Frank, that's an after-tax payment. They're taking money out of their qualified plan. So it takes them $1,900 to net $1,500. So when we got rid of that mortgage payment, we'll multiply 1,900 by 12 months. That's $22,000 that stays in their retirement savings account. So now they don't have to draw out $30,000 a year because we've eliminated 22,000. They only have to draw out 8,000. So they can live like 30,000, but it's only going to be 8,000. Their savings is going to last another 10 to 14 years, and we're going to minimize the taxes, maybe even get them to a lower tax bracket. And the last thing I'll say about this is something most people don't know. You watching, you know someone who has a mortgage payment. Frank, you know that. Here's the question. I have one. And the question is, Mr. and Mrs. Jones, since you're already making a monthly mortgage payment, I'm curious, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? Now, Frank, what are most people going to say?
Everybody would take voluntary.
Everybody. And I say, me too. I ask them, why would you take a voluntary payment? And they say things like freedom, flexibility, control, sleep less, or sleep better, spend less. And I simply say to them, so if you could eliminate, if I could show you how to eliminate a mandatory monthly mortgage payment so that you can spend less, sleep better, give more, have freedom, flexibility, and control, would you want to see how it works? Absolutely not. And so we won't cover it here, but suffice to say, most people don't know that you can use a reverse mortgage to eliminate your traditional or take your traditional payment and make it voluntary. Let's pause right there. Let's go back to you and I chatting here. And so those are, and I don't want to just get bogged down talking. And but when you see that, when you first heard that, and you thought about the years, because you thought about more than just yourself, Frank. You thought about the people you serve. You're a servant leader, and you thought about this is important to my folks to have a cursory knowledge of this. And some of those examples I gave when I was on stage, but one of those, which one of those maybe really caught your attention?
So, Don, what caught my attention was a couple of things, which is, here we are in 2025. Through the month of April, we've had market volatility.
Mhm.
Back in 2022, we had, rising interest rates, very rapidly. We had a negative market, both bonds and equities. And so one of the things that kind of occurred to me is we call it sequence of return risk, which is, when we have people that are in retirement, when we have a down market and they're taking money from accounts,
Mhm.
one of the concerns that we have is, if that extends that, down market for any period of time, it can jeopardize a retirement account.
Mhm.
And then when I sat in on your presentation and you were showing how, you can reduce some of that sequence of return risk
Mhm.
by utilizing in a down market housing wealth,
Yes.
okay, allowing funds to stay invested, allow the market to recover. And then if you even want, you can always put the money back in the house.
Mhm.
That extra bucket of capital to have liquidity and availability, to me, that clicked.
Mm.
So I kind of saw it on that one. Then the other one that clicked for me was we have, we'll come across people that are going into retirement and they've
Mhm.
done a nice job. They look like the last example, they have a
Mhm.
$500,000, they have $1 million. But then when we come to that proverbial 4% rule,
Mhm.
okay, and they look and they go, wait a minute, on 500 or a million, that may equate to 20,000 or 40,000 of cash flow. I was envisioning more.
Mm.
And
Mm.
so, we're down here in Monmouth County and we have homes over, close to the shore that could be worth $1 million, $2 million people are living in,
Mhm.
and they love their home, they love where they're at. But that $1 or $2 million home has associated with it, a 20 or 25 or $30,000 tax payment.
Yeah.
And so, you look and they go, well, they have housing wealth, but that wealth is actually a liability in retirement.
Mm.
And then, if that house can help to solve some of that problem,
Yes.
and when you were going through that presentation, I looked and I said, this is not for, someone who's running out of money. It's for
Mhm.
someone that strategically wants more cash flow. They want more lifestyle in retirement. And it just seemed like it was a way that they can open up options that they didn't even know were available. And as an advisor and a firm with all advisors, I just felt, and that's why we just spent a couple hours with all the advisors,
Mhm.
making sure that they know this is a conversation that people need to know is available to them.
Yeah.
That was how I saw it.
That's so important. And I like you used oh, what's the word you used earlier? Oh my gosh. And not wasn't architecture, but when you talked about putting it all using the reverse mortgage in a coordinated way, but you had a
Yeah.
word for it, and I forgot what the word was. And
It's okay. We're in New Jersey. I forget them too. It's all good.
let me show what you just talked about, which was how do we use this in a coordinated way um, when we're looking at sequence risk or some other kind of concerns. So let's take a look here. I'll cover these last few. Using the home. If you could use your home to reduce the income taxes you pay in retirement, would you want to see how it works? So, Frank, I said earlier, how many of your clients would just yell out, no? You're watching this and you're saying, no, I don't want to learn about that. Well, Bob and Sally have $1 million in an IRA. They've done pretty good. They have a $650,000 home, and they never thought it would be 650 when they bought it years ago. Who knew? So now they're concerned about taxes. And so their advisor says, well, we can talk about moving those taxable dollars over to make them non-tax through a Roth conversion. That's great. We don't want to blow up your tax bracket. So what if we move $100,000 a year every year until we move the million? That's great. But when we move this money, the $100,000 is going to show up as ordinary income tax. I've got to pay taxes on it. So I say, where do I get the money to pay the taxes on the Roth conversion? Do I get it from the asset itself, meaning I don't roll over 100,000, I roll over 78, or do I get it from some other asset, life insurance or cash? Or can I use a reverse mortgage to do that? I said, all of those are good questions. They should be weighed. So let's look at a reverse mortgage. On your screen, you'll see their reverse mortgage made $194,000 available. Now remember, a reverse mortgage is a growing line of credit, so it's growing by $14,000. So we're going to pay the taxes on the Roth IRA conversion to $22,000 from the reverse mortgage. And then at the end of the year, our reverse mortgage balance is 186,000, and we do it again next year. Matter of fact, we do it for 10 years. So at the end of 10 years, if that money was growing at 8%, now we've got $1.7 million, all tax-free, growing for us. We don't have to be concerned about RMDs. We can pass this on to our heirs. Um, and so the conversation is, wow, I could convert some of this money to non-taxable money and use the reverse mortgage to do it, or a combination. I use the reverse mortgage, some cash, some life insurance, but it's a conversation worth having. And so preserve assets from premature erosion. This is what you were talking about earlier, Frank. The question is, if we could use your home to create a backup plan for market risk and volatility, would you want to see how it works? No one's going to say no. Not one of your clients is just going to scream no. So Dr. Wade Fowle, probably America's premier retirement researcher, said this: small movements early in retirement make a significant impact on the long run. Pierce and Linda have $1 million IRA. Their advisor says, we'll do an initial withdrawal rate of $40,000. They're not happy, but
Yep.
okay, they're going to work with, and they need it to last 30 years.
There's that safe withdrawal rate.
There it is, safe. Now they heard some television guy say you can draw 10 or 12% and still be safe, but the advisor says that's not so because of the sequence risk, which is if you take out money in a down market early, it's gonna premature cannibalize your asset. So I'm gonna give you two examples. One is, well, how much can I draw out if I want my money to last 33 years? This is the work of Dr. Wade Fowle. He says about 4%, 39,500 to last He says, what if I spend, oh, went the wrong way. What if we spend more? If you spend more, you may run out of money earlier. Now, here's the counterintuitive. What if I, instead of taking out 39.5, I take out 37.5? Well, Frank, wait a minute. I wasn't happy with 39.5. You're saying take out less? Well, if you take out less, look what happens. Now you end up with the same amount of money that you started with, but I'm not happy. Then Dr. Fowl goes on further and says, what if you take out 35.5? That's $4,000 less per year. Says if you do that, now at 33 years, you've got $2 million left. And the client's like, wait a minute, I wasn't happy at the first number. Now you're telling me to do less, but they are intrigued by the fact that, but my savings could last significantly longer, meaning if I'm still alive, I've got it to live on, or a bigger legacy benefit. So the question is, you see it on the screen. Well, I don't have to reduce my draw necessarily. I can still take out 39.5, but 4,000 of that is going to come from my line of credit, even more. So I can have my cake and eat it too. We're going to see that. So I'm going to draw less from my portfolio, but it's not going to cost me. I'm going to have the same lifestyle because I'm going to use that extra 4,000 from the line of credit.
So you've got lifestyle and cash flow,
Absolutely.
and all that you're doing is utilizing another asset.
That's it.
And that's, one of the benefits of, just understanding how it fits in this orchestrated plan,
hmm
that it's not the last chess piece on the board. It can orchestrate with other
That's the
things.
word, orchestrated. Thank you. Someone remind me, I got to write that down, or I'm going to use it from now
I'm
on.
gonna write that down. I'm gonna charge you a
orchest-
quarter every time you use it.
Orchestrated plan. And I don't show the sequence risk here, but let me share this last one because we talked about it. And which simply was, if the market is down, don't take money out of your portfolio securities for income needs. Take it from your fourth bucket. And if you do that, you're going to radically preserve savings, even have more money at the end. The point is, this reverse mortgage line of credit, this fourth bucket, gives opportunities for you to orchestrate and align all the buckets for a longer retirement. So finally, adding new dollars, which is of course my favorite, you can buy a home using a reverse mortgage. And I've done several here down at the shore. And here's how it works. Someone says, hey, Don, I've got a home. And after I paid realtor costs, I've got letter A, $600,000 left over. I paid off my existing mortgage. Now, if you watch this podcast here, you know anytime there's an existing mortgage, there's a way to use a reverse mortgage to pay it off if you wanted to stay in their home. But they wanted to move. So letter C, they've got $500,000 left over, and they're going to move inland a little bit to a $400,000 home. And their thought was, I've got 500 left over, I'll just pay cash. And I said to them, Frank, well, you could, but what happens if your home goes down in value? Now you've locked up your proceeds, or what if you need the money out and you can't get it because lending policies have changed? So letter E says we did a reverse mortgage before they even moved in. The reverse mortgage made $160,000 available. So let's subtract that from their purchase price on their new home. So their down payment is $240,000 to move to a $400,000 house. Well, that's easy. You have $500,000 left over. So at the end of the day, they have a new home, no mortgage payments, and $260,000 in cash to add back to their retirement savings. Sometimes I ask people, it's like that old song, should I stay or should I go? Let's go back to screen time, you and I. And then so I say to my first question is, go ahead. My first question is, should I stay or should I go? Mr. and Mrs. Flintstone, um, have you ever considered moving? Is that an option? And sometimes I put it like this. I said, if I can increase your cash flow, reduce your expenses, and add new dollars back to your retirement savings, but it meant moving to your next, last, and best home, would you want to see how it works? Now, sometimes people instinctively say no. Little Billy and little Bobby and Betty grew up here, and so they're all grown people. Are they coming back? You've got this giant house. You bought it for 45,000. Now it's 600. You bought it for 185. Now it's 1.2 million. You never dreamed that. But your retirement savings, your bucket may be a little low. What if I could add five, six, $700,000 back to your retirement savings? But it meant maybe moving inland a little bit, but you got another six or $700,000. You may have a slightly smaller home, but a significantly larger retirement. Would you at least want to see how that works? And so that's a huge conversation to have. And it's just one of 52 strategies that we talk about. And Frank, we shared, and certainly, hey, folks, um, Frank's folks and their group, they're aligned with me. I serve as the National Business Development Manager for a Fortune 300 company, the largest lender in the reverse mortgage space. So 49 states, I give leadership to a team of 200. And so it's a name you would know. I don't talk about it here, but you've got Frank. And I talk to a lot of advisors. Seldom do I get up at the crack of dawn and drive somewhere more excited than driving down here because Frank, I mean, you really get it. You have honored me to be able to share with your team and then the folks who are watching this to say, it may not be the right thing for you to do. Folks, hear that. This may not be the right thing for you to do, but it's not a spooky thing. It's I just drove past Six Flags coming up here. You remember when you went to amusement park when you were little, and Mama said, "Oh, be careful, Spooky Land," because the last little girl went in there, she never came back, and that's where people put reverse mortgages in Spooky Land. I said, "This is not in Spooky Land. We're over here with the teacup and the Ferris wheel." I said, "It's not new, folks. It's not dangerous. It's not spooky. Certainly, it can be misused." But when you're working with a financial professional, holistic, protection first, comprehensive, like this group here, you're going to be able to see the usages of it, the strategic orchestration, that's our word, orchestration, and how when you orchestrate it versus isolate it, it gives you so many more advantages.
It's a great insight. And, times when I, showed up, down in Dallas and I'm sitting in that room and I was like, oh my goodness, I see so many different uses for it that it went from being, in my mind, the last piece on the chessboard, where you're just moving around trying to avoid getting stuck, to actually looking and saying, where does it fit based upon somebody's individual circumstance and, whether it's a new home, a second home, whatever the case might be, it's an asset that at some point is going to be utilized, and it can be utilized either the kids when they inherit it, or it can be utilized by the client and the homeowner themselves throughout their lifetime to give them a better quality of life, and also perhaps as a strategy to build more wealth. Now, certainly not for everybody, but like anything else is, I think everybody owes it to themselves to just know that, your home is an asset that, first book I ever wrote was, it's a cash flow liability, but you can turn your home into a cash flow asset if you put strategy around it in an orchestrated plan. And in that place, that's when, I saw you speak and I was like, somebody who gets it and understands it. And that's why I felt, God put me in the room at that time with, to say, I need to be aware of that. And so it was just a wonderful insight. And that's why we're happy to share it with our community.
And I think I want to say this, that I believe your position, and you correct me if I'm wrong, that none of the advisors I partner with and work with, I would say recommend a reverse mortgage. Here's what they do. They recommend education around it. They're saying that this is an important tool. It's an important asset that you have. Be educated about it. Understand the pros and the cons and what it can do and what it can't do. And then they partner with education resources. And we have a master class. Frank, I don't know if you want me to tell folks where they can watch the master class.
Go ahead.
But you can, if you're watching this, you say, well, is there a place where I can get some education around it? Sure. Go to www.housingwealthmasterclass.com. www.housingwealthmasterclass.com. It's an education presentation. The things we saw today, just expanded to about 47 minutes. And then at the end of that, you may say, gross, this is not for me. You could say that after the first 7 minutes. I say, Frank, I tell folks, just watch the first 7 minutes. There's an exit ramp at 7 minutes. But if you watch it and you may come away saying, you know what, I'm glad I had the education. Thank the person who gave you the education. And now you can begin to make an informed decision about a comprehensive, holistic, protection first kind of retirement plan. And I believe, and so I don't want anyone to go away confused that we're talking about being educated about a resource that can really I think provide some value for the right situation. Is that fair to say?
I think that's perfectly on point, which is why we do our Wisdom Wednesdays. You know, and I used to tell people, it's like, look, can't predict the market, can't predict rates, can't
Mhm.
predict the economy. However, you've been fortunate to, accomplish what you have up till this point in time in your life. And to just understand how every piece of the puzzle can be fully maximized and utilized throughout your lifetime for your benefit or for the benefit of your family. Um, it's our responsibility to make sure that you're aware of what your options are and how they work. And that's the reason why when I caught your presentation, I was like, we were missing the full story on it, but now I think we've got it. So for us to have that conversation and to help our clients to understand, is it something that's worth considering? Does it fit? Does it not fit? But
Mhm.
to at least understand the option.
Thank you. Yes, absolutely. So
So
that's all I got.
very good. Don, it was a pleasure spending time with you today. Again, your insight, your education on it, and you know, everything you've done, I really appreciate it. And you've taken a very, could be AKA complex uh, product and process and made it very simple and very understandable for people to understand how it works, where it fits, and also where it doesn't, because it's not for everybody. But if it is for you, you just need to be aware that it's an option. So it was a pleasure to be with you. Again, Don, thank you for being our guest this month. And for all of our listeners, we look forward to seeing you next month. Thank you and have a great summer.